Hello, and welcome to the third panel of this year's SRI conference, which we've called Towards a Green Treasury, New Developments in Green Fixed Income. In it, we'll be discussing how treasurers are pushing further than bonds and loans and trying to move their funding profiles entirely green. We'll primarily cover the rise of green CPs and corporate deposits, also touch on green derivatives or even perhaps green FX. I'm Silas Brown, the Leveraged Finance Private Credit Editor at GlobalCapital, and I thought we would start by just getting my fellow panelists to introduce themselves, perhaps starting with you, Arthur.
Absolutely. Good afternoon, all. Thank you for the invitation, Silas. My role is being Head of Sustainable Finance at NatWest Markets for our corporate client base. And when I began doing that about 5-6 years ago, that was quite a one-dimensional conversation. It was kind of focused around the green bond concept. But where we've evolved to today is discussions that evolve exactly to your point, Silas, around embedding sustainability across different treasury functions, whether that is cash management, reporting, investor relations, finance, liquidity, to move to holistically sustainable treasury teams rather than individual siloed sustainability projects within a treasury function.
And maybe you, Alessandro.
Hello, everybody. I'm Alessandro Canta, Head of Finance and Insurance at Enel. We have been working very hard in order to align the financial strategy to the sustainable strategy of the company that started in latest 2014.
And you, Eusebio.
Thank you, Silas. Good afternoon. My name is Eusebio Garre. I am the Head of Funding of IDB Invest. IDB Invest is the private sector institution of the Inter-American Development Bank Group. We are a supranational issuer, a multilateral development bank focused on promoting the development of private sector companies in Latin America and the Caribbean. Our business strategy focuses currently on 5 opportunities: regional integration, strengthening value chains, support for small and medium-sized enterprises, promotion of a digital economy, gender and inclusion, and climate action. Earlier this year, we launched a sustainable debt framework aligned with the green bond principles and social bond principles. Since then, we have issued sustainability bonds, social bonds, and a green bond under our framework, and we have also set up a sustainable commercial paper program that we expect to launch in the future, which will allow us to issue sustainability CPs to fund eligible projects under our framework. So we are, as an institution, very invested in sustainability, in impact, in ESG, and as part of it, the Treasury is also exploring ESG opportunities, starting with the funding team and investor relations. Glad to be here to join this distinguished panel. Thank you.
I'm very glad you're here too. And maybe we'll start with you, if that's okay. Just on CPs, one of the things that I found interesting is whether or not investors, CP investors, how convinced are they by the concept of green CP, sustainable CP programs? Do you get the impression that they are they're kind of interested by the progress of green and sustainable finance in their market?
Mm-hmm. We have been most active in the bond market, and there it is certainly no question that the investor interest has skyrocketed over the last couple of years from a very modest interest in the initial issues of peers of us, of multilateral development banks, to becoming a really mainstream market where not only supranationals, but also corporates and governments really provide a steady supply of green, social, sustainability and sustainability-linked products for bond investors. The CP market has certainly lacked that development, and we, as an issuer, just structured our program and are yet to launch it. But in the conversations with our dealers, it was very clear that they saw a lot of value for us as an issuer in structuring that program as a sustainable program, mainly for 2 reasons. First of all, because to support our brand as an issuer, as a sustainable issuer, an institution focused on impact and sustainability. So they told us it will certainly be recognized by investors. And also because they do see that initial programs set up by mostly corporates and financial institutions targeting sustainability and green investors have received a very positive response. It's fair to say, in my view, that it is not yet nearly as mainstream a market as it is in the bond market, but that from what we can see, there is an increasing interest, mainly from investors who are already strong ESG-focused bond or equity investors. They kind of are extending the ESG across the asset classes, but it's still an incipient market in my perception.
Arthur, as someone who perhaps has more of a panoramic view of sustainable finance across capital markets than I do, do you expect the CP market to kind of follow the same trajectory as we've seen in syndicated loans and bond markets? I mean, is it on the same course of progression? Do you think?
I think that's certainly a likely forecast. When I talk about the green CP market, indeed echoing Eusebio's comments, it's very much currently where the sustainable bond market was in 2015 and 16. You've got early adopters on the issuer side. You've got some initial ESG-aligned funds on the investor side, but it's not yet mainstream, and it's not quite clear what the pricing, benefit to greenium is, and that still makes it, puts in quite an early stage. Our expectation is that we'll see an S-shaped growth momentum in this market. Driven partly by investors who are integrating ESG considerations across their portfolios, so not just the bond portfolio, but also the money market portfolio, but also driven by the issuers. If I look at the most recent frameworks that we've structured and our pipeline of future sustainable finance frameworks that we're helping with, almost all of them allow for a CP issuance. It's not just bonds, it's about all the debt in an issuer's capital structure. So Silas, that's certainly my base case, that this will become much more of a mainstream instrument.
Alessandro, if you could walk me through the funding benefits that an issuer might get by borrowing in a kind of green CP format, that would be, I think, very interesting.
Yeah. Listen, I mean, I can take for the benefit of the audience, our experience, because we already have in place almost 15 billion euros of sustainable link commercial paper, split between Netherlands, where we have our financial company, and Finance International, Spain, where we have Endesa, and also, very interestingly, Enel Finance America in North America, that is the financial vehicle by which we are supporting our renewable growth in North America. To tell you the truth, I totally agree with my friends. I wouldn't say it's an early stage. It is quite difficult to ask to an investor that is already paying you in order to issue commercial paper, because we are issuing a minus 40 basis point to get a discount. But interestingly, where the interest rates are positive in the United States or North America, when we have transformed our outstanding commercial paper program of Enel Finance America into a sustainable link program, we got immediately a price benefit. So this is a signal, it's signaletic, and is showing the importance of being sustainable, because as we always repeat, sustainability is value. And so to the extent that investors can afford to recognize it in the pricing, I think that it will come. Let me say that in any case, an immediate benefit you get from that is to enlarge your investor base, because a lot of investors are hungry to get a sustainable product overall, no matter what is sustainable link product, sustainability product, or green bond, or green commercial paper. this is a market that is a fast-growing market by which the demand is there. We have only to find a way to channel this huge quantity of money that need to be invested.
A coupon step-ups difficult or more difficult to achieve in the CP market than kind of longer dated debt markets. I mean, that's presumably a challenge for all those interested in developing sustainability-linked CP programs. Alessandro, if I might ask that question to you and then maybe open it up, that would be great.
Yeah, you are totally right. Meanwhile, we have invented the sustainable linked bond features that now is an asset class. It is quite difficult to apply a step up whenever you will not respect a certain KPI when we speak about commercial paper. And so we have committed ourselves to the same KPI. And basically, the feature is that if we will not be respectful of this KPI, that is a substantial part of our strategy, basically the CPI will not be effective anymore. So is a strong commitment on our side, and it's not basically implying a step up, but even worse, let me say. Besides the reputational risk that you may suffer the very moment in which you will not respect the KPI, you will not be entitled anymore to utilize the same program.
That's interesting. Eusebio, when you've been having your preliminary discussions about developing a sort of sustainable CP program, what have you made of step ups in the market? How you can achieve a similar sort of format, but kind of tailor it to a more kind of short-dated asset class?
Yeah, look, I absolutely agree with Alessandro that given the short maturity of CPs, step ups, which are linked to institutional long-term goals, long-term KPIs, don't seem to be a good fit. So that's not the instrument you would expect in the CP market. I think that their approach, Enel's approach, is bold to say, look, if we don't achieve these KPIs, then we will not use this program. Like it's a very, very strong commitment, and it's an alternative way to telling investors we are a green company. We are committed to these goals, and that's the way we show that commitment. In our case, we are a multilateral issuer, and for multilaterals, sustainability linked bonds don't seem like or sustainability linked instruments don't seem like a natural fit, because the underlying assumption for sustainability-linked structures is that an issuer is in transition from wherever it is today to a greener issuer or a more sustainable issuer, and that this is an institutional matter, which is why you don't refer the proceeds of the issue, but you really look at institutional KPIs. A supranational, a multilateral development bank is, by its own goal and definition, already focused on sustainability. It has already, we have the most stringent ESG frameworks and impact frameworks, and which have been a reference for others when this market started. So this transition element is missing. So to imply, oh, we need to become green or much greener is not really the purpose. The purpose is we want to finance projects which are green, which have a green or a social impact. So for us, our thoughts were, let's go for a use of proceeds framework where the CPs will finance projects with a clear social and or green impact and report on those. That's because of the type of issuer we are, together with the dealers, that was what was seen as the most appropriate structure for us.
Arthur, if you look at the kind of, if you chart the sort of historical progress of the bond markets, you and sustainability within the bond markets, you see effectively sort of green use of proceeds bonds, and that kind of transitioning and sort of sprouting out to more kind of complex sustainability linked structures. I kind of think from some of the observations made today that perhaps the progress of the CP market when it comes to sustainable finance might be more tilting towards the green use of proceeds element than the sustainability linked element. I don't know if that's just missing the mark slightly. Do you see the kind of green use of proceeds format as more of a neat fit than sustainability linked structures?
Yeah, it's a great question, Silas, and I'm always very careful because in my view,
pick a size, yeah,
an issuer shouldn't be there's no religious preference, if you like, for any one of the technologies. From my perspective, they all have their distinct benefits and considerations, and it really depends on the asset, on the issuer, what is most suitable for them. I mean, yes, it can be straightforward for an existing green bond issuer to convert that technology into green commercial paper. But if that same issuer issues, commercial paper with an 8-week tenor on average, it can become quite cumbersome to do all the project reporting for that kind of time span. So it really depends per issuer. What we've seen so far is that there's sort of 3, I guess, categories of ESG CP that seem to be growing in prominence, and my 2 fellow panelists have each set out 2 of those categories. So on what Alessandro has described, the sustainability linked commercial paper, what Eusebio has described, the use of proceeds commercial paper, and then the other flavor that we've seen is what I call an ESG undertaking commercial papers, where a company commits to maintaining a certain ESG rating or ranking, and if they were to lose that, they need to communicate that to the market, and as Alessandro has described, they will then be locked out of issuing further ESG commercial paper. And an example of that 3rd category is the commercial paper program from Holcim that commits them to maintaining a top 25% Sustainalytics ESG rating. So look, Silas, back to your question, I think we'll see supply across those 3 technologies dependent on an issuer's specific preferences and considerations.
I'd love to carry on speaking about green CPs, but I'm slightly cognizant of time, and I'd love to move the discussion on to corporate deposits and whether or not you can deposit money, or companies can deposit money in a way that's green. Alessandro, maybe I'll start with you. I mean, is that a kind of new frontier for sustainable finance, and what's your opinion and experience of it?
I mean, for sure, now we are giving to all the product a certain label. The ideal world will be the one in which we will arrive, for sure, in which we will stop to give a label to a product, and we will be evaluated as a company in terms of sustainability, sustainable strategy, and a certain ranking. And the very moment in which most likely rating agencies will fully integrate the sustainable metrics into the credit metrics. So I think that at that point in time, we will stop to give label names to product. When it comes to deposit, our situation is a little bit different from the other one, because we are very cautious about liquidity, and we have a big treasury department, and we have certain swing on a daily basis that basically allow us to deposit overnight or at least 1 week, not more. So we are not an asset manager on that standpoint. But when it comes to my insurance company, the captive insurance company that is regulated, and that company is in Netherlands and has to seek and to respect the Solvency II, we are experiencing also deposit that are going towards the green format. Even there is no any, say, pricing advantage. There is only our willingness, as we were saying, to try to convert all the product coming out from our treasury department or our company into the sustainable format. This is what we have been doing also in the trade financing. and as everybody else in the credit line facility. But even recently, last year, we have done it also in insurance market. So to address your question correctly, we still are not experiencing that on the bulk of our liquidity for the reason I said before. But in part of our management, we have already been experiencing such a kind of green format without any major price differential.
Eusebio, what do you make of the discussion around, I suppose, green deposits for companies? I mean, do you have much experience of it yourself? Is it something that your institution would choose to do, or do you think it's a
It's a very interesting question, because as Arthur alluded to, I think all treasurers are right now kind of getting their heads around how can I contribute to this massive global trend of sustainability? How can I get my operations more sustainable? And I think even those who maybe didn't really want to, or didn't want to at all 3 or 5 years ago, and said, hey, I am here to take care of the liquidity, to manage risk. No, don't bother me with green and labels. I really don't have time for this. And my field of action is already narrow enough. I need liquid banks. I need very stable banks. I cannot diddle around with. So I think all of us have heard this type of talk from seasoned colleagues in the past, and I think pretty much today, fast forward 3-5 years, everyone is realizing, okay, this is a global trend. My own board is asking, my top management is asking, so what can I do for it? And really looking for opportunities to integrate this greenness and sustainability in our treasury products, and so are we doing. In terms of deposits, I think it's still similar to the CP market. It's still kind of a marginal market. You can find that, and in our concrete case, it is not yet a focus of our activity. We think that you can take an approach. You can start looking, for instance, at the sustainability ratings, public ratings of banks. You can, as a matter of fact, develop your own internal methodology. For us, it is a matter of second order at this moment. We are focused on our profile as an issuer, and also on the profile of the long-term investment portfolio, where the criteria are more clear and the methodologies are more advanced before we really formalize something in our policies. And yes, I think it's important for liquidity management to keep in mind. It is a critical survival function of any company to manage the liquidity flexibly. So any policy around it needs to be flexible enough to kind of not come in the way of the main of the main function, which is to ensure the functioning of the institution in any market environment.
Just on the different strategies I might employ, Arthur, if I was a company and I was looking to deposit in a way that was green, what are the options for me now? I suppose I could perhaps select a bank that had a kind of sterling green record. What are the options that I might have at my disposal at the moment?
Absolutely, and I think this is an exciting discussion. Let me just say that at the outset, because deposits are clearly the most accessible banking product, and lots of companies that won't be doing public bonds or indeed investing long term their cash. So deposits are a great common denominator for treasurers to take some steps in a more sustainable direction. And on your question, Silas, is fundamentally two approaches that you can take, and they're complementary. The first is, and that's Eusebio's point, you can look at the counterparty. So you can either use an ESG data or rating provider and rank your target banks that way, or you can use your own questionnaire, your own approach to make sure that your deposit counterparty shares your ESG values and priorities. So that's one thing you can do. And the second thing you can do is to filter banks for those that have green and ESG deposit products. Even if to Alessandro's point, they may not come at a very different yield or very different return. And certainly what we've seen in the last 2 years is that more and more banks now offer both large corporate clients, SMEs, high net worth individuals, some of these ESG deposit solutions. We rolled out our ESG deposit product 2 years ago, and what's been really exciting is that our own treasury has noticed that having that deposit product in place has helped them both broaden the universe of clients that place deposits with us, but also from a commercial point of view, those deposits tend to be stickier because a client who places a deposit in an ESG or green deposit structure does so for more reasons than just placing liquidity. So those tend to be a little bit stickier, which is helpful as well.
Alessandro, just carrying on corporate deposits. If companies appreciate a greenium when it comes to their debt issuance, is the inverse then also true when it comes to their deposits? And actually, deposits should yield less if they're done through a kind of green format.
Yeah, this is a very interesting question, because if we want to really establish the idea that we are sponsorizing since a long way, that sustainability is value, we have to apply reciprocity, by which if I deposit in one bank that is more greener than another one, due to the fact sustainability, that means that the company, either the bank or a corporation or a DFI, if it is sustainable, is less risky, more resilient, and more profitable in the long run. For sure, we should have applied a certain discount in terms of reciprocity. That's how finance should work. Let me say that that could happen also when we're going to see on the bank side a certain mechanism on the other side when they're going to be lending money, because everybody of us now knows that they are lending on the sustainable format, but they don't have any mechanism by which they have an economic incentive to do that. So even there, in terms of reciprocity, we are waiting ISMA to come with a certain solution by which they're going to have, in the case of lending, less capital utilization when they're going to be lending in a sustainable format to sustainable company. And at that very moment in time, I'm sure that also the treasurer will apply the same reciprocity by which will be inclined to deposit money with a less return in case this investment is into a bank that, as Eusebio and Arthur were saying, is judged as a sustainable bank by the treasurer itself.
That's very interesting. Eusebio, at least in principle, do you believe that corporate deposits should yield less?
I think it's a great question. It's a bit philosophical because I think Alessandro already alluded to this. If green banks are more successful, more resilient, and more stable because they're green, they are less risky, and therefore investors would automatically accept a lower return because they are less risky, whether the investors care about green or not. On the other side, if being green does not include increase your sustainability and lower your risk as an issuer, then you would need an external factor to trigger a price differentiation, which could be, as Alessandro meant, possibly a regulatory rule, capital requirements, etc., internal policies imposed by the board for non-economic reasons or for non-yield related reasons, like some external factor which motivates the treasurer to accept that yield. Apart from that, I think when you manage liquidity, your paramount criteria are liquidity and yield. That's what you really are supposed to be doing, and you would need that internal trigger to to kind of accept a lower yield and justify it.
Arthur, maybe just touch on the question that I just asked the other two panelists, but also we have a question for the audience about what are green deposits usually invested in, whether or not they're in green CP or bank loans. I don't know if you want to touch on that.
Yeah, very happy to cover both. From a typical bank green deposit perspective, there's often a big overlap between what a bank invests in for its green bonds and what it invests in for its green deposits. So it tend to be indeed lending to renewable energy, green building related projects. So there tends to be an overlap there. And that, I think, is important for this question about the greenium. If I'm a treasurer for a financial institution and I've got limited green assets, a limited green loan book, and I look at where can I get the best bang for my buck, it tends to be by linking those green assets to green bonds, because as we know, there's a very well established greenium, and then I can get quite stable long-term funding. So there's certainly a pressure on some banks when they are then allocating green assets to deposits to show slightly tighter pricing to justify that, because there's such limited assets that they can look at. So to your point, Silas, there's definitely pressure there, and there are some companies, again not a majority, but there are some companies where the treasurer is so focused on placing more money in a ESG friendly way that they will accept that, right? That they'll be a little bit less price sensitive. But I don't think it's the norm. I mean, certainly at NatWest at the moment, we're still showing the same curve for green and regular deposits, albeit certain not to be named advisors have told us that we can start showing 2, 3, 4 basis points difference between the two.
Eusebio, would you like to comment on the audience question?
Absolutely.
Just to remind the audience as well as you, the question was around, what are green deposits usually invested in? Does it go into green CP or bank loans? Yeah, any clarity on that would be great.
Sure. Of course, it is the decision of every issuer or of every deposit-taking institution to decide what they do with their deposits. In our case, we currently are not offering sustainable deposits, but were we to do so, or let's put it this way, we offer sustainable CPs, which can be allocated, and those could be an alternative product would be to offer deposits. In our case, our framework would not see green CPs as eligible assets, because you are kind of selling a green product which refers a green product which has a green impact. You could create an endless chain of green things and zillions of green CPs or deposits, which one single project, right? So in our case, only is eligible projects, which in our case can be green, social, or sustainability or sustainable, are eligible as underlines. That's again our specific case at IDB Invest.
Speaking of everything turning green, how about green derivatives? I guess my at least intellectual thought about green derivatives is that derivatives are in essence, the pricing of derivatives is in essence driven by kind of risk considerations, and that's what I find it in a way harder to understand the integration of sustainability links considerations, maybe green considerations, into the kind of pure derivative. It might be because I lack kind of imagination. Arthur, perhaps you can help me out here. Just on, I suppose, the additional challenges that the derivatives market might have in integrating sustainable finance into its offering.
Yeah, absolutely. I'm happy to start there. I think on your philosophical point, I think we've got to bear in mind that for an asset to be managed successfully, or need a company to be run successfully, yes, there's financing, there's liquidity, right? We've got bond and loans, but equally there are a host of other financial instruments that a treasurer needs to have at his or her disposal, right, to facilitate various risk management exercises for that asset. And that's really where the world of derivatives comes into play, and then they play an important role, right, for the future stability and success of that asset. So I think we always need to see that as part of the wider toolkit. So for people who provide financial services to treasurers to give them the right incentives, and we as a bank are of course in that position. We don't just want to do that through necessarily just the financing tools, but also through other tools such as derivatives, and look at ways we can embed sustainability incentives. You're absolutely right to say, Silas, that it does create challenges in a way that a bond or loan doesn't necessarily have. For instance, these need to be marked to market on a daily basis. There's certain monitoring involved. There's certain risk management involved on these instruments. So if, as a banking provider, you've got a whole portfolio of them and they all have completely different targets, that can create certain risks on the balance sheet. And then of course, how do you then sell them on to other banks if you need to innovate your position? But I think as we get more sophisticated in terms of our understanding of credible ESG KPIs, of credible ESG targets, in a similar way that we are at the moment on credit risk, I think those challenges can be overcome.
Alessandro, what do you make of the kind of intrinsic challenges that the derivatives market might have when it comes to green and sustainability linked issuance? Just to move it on in a way, in some respects, one of the other things that I perhaps struggle with is the fact that derivatives in and of themselves aren't financing anything, and maybe that is just a new frontier for sustainable finance, and a great illustration of its ability to spread across financial markets. But any thoughts on that would be much appreciated.
Yeah. First of all, we all of us have to contribute, try to change the idea behind the utilization of derivatives, because derivatives has been, has done a lot of bad things in the past, by which, first of all, we have to refer to the good size of the coin of derivatives. That is, for us, the industrial way in which we utilize it. That is part of our business. It's not something done for the sake of something. Is totally integrated in our strategy in order to cover capex, in order to cover the raw material acquisition, and so it's strategic. When we refer to such a kind of derivatives, the sustainability feature that we have applied, I mean, we started studying, as everybody else, the first cross-currency had a certain feature by which the differential we would have paid on the cross-currency would have been invested by the banks in some sustainable project. Afterwards, we arrived to the bilateral features in the latest cross-currency that we have done to cover our issuance in United States dollar, by which even there the reciprocity has been applied. And what is the sense of putting a sustainable feature into derivatives? I mean, sustainable finance has two different objectives. First of all, as we were saying, to channel the investment in the right way in order to finance the transition and the decarbonization of the world and all the objectives that we have. The other one is to show to everybody that there is the possibility to push forward some positive behavior and try to emulate a certain manner, solicitate people to go towards the sustainability. And the derivatives could be a good example of that, because, for example, we have started to close framework with banks, because going product by product would be a mess, by which we have closed framework with the banks, by which all the amount of derivatives that we're going to be doing with them on a yearly basis have this kind of feature, by which if we're going to be respectful of the same KPI, fine. If we will not be respectful, there will be a step up. And on the other side, if the banks would have not invested the amount they have declared in their strategic plan into sustainable project, they're going to be paying more. So if you look at the derivatives in this way, let me say that derivatives are there to demonstrate that there are positive behavior also on that part of our financing strategy. The economic feature is not relevant even there. But as we were saying before, if we want to make of the sustainable finance mainstream, we should have to start to think that besides the product and beyond the product, all our activity have to be driven by sustainability.
Arthur, I might come to you, and then I'll come to you, Eusebio. Yes, the cynic inside me says, well, this is a challenge for the reasons that are obviously being outlined. But I suppose the more earnest part of me says, well, it would be a deep shame if the derivatives market, a massively important and large part of financial markets, was totally left out of the conversation. And I think, I don't know whether or not you think, you know, as a bank and as an institution, you should be kind of pushing green derivatives. Whether or not you think that this is this is actually a very important part of sustainable finance in the future.
Absolutely, I think for us strategically, you know, as a bank with a purpose-driven agenda, it is our aim to ensure that our corporate clients can meet their various treasury objectives. And Alessandro has laid out that risk management is an important treasury objective, so that our corporate clients can meet those objectives in a way that's also aligned with their sustainability priorities. So for us strategically, it is very important to see a evolution of a credible ESG derivative proposition. So we're certainly looking at supporting that.
Eusebio, I'm also cognizant we only have a matter of minutes left, so I'd love you to just to have some final thoughts on derivatives and kind of the greening of the derivatives market, but also perhaps touch on a kind of even more novel concept than that, which is around green FX, and whether or not that's a goer in your view.
Happy to. I think a lot has been already said, and I agree with Alessandro that derivatives are an instrument which can be used in good ways and in less good ways. Similar, and to use the analogy, as explosives. You know, you can use them to destroy cities, you can use them to build bridges, to build tunnels, and to do great things which we need for our infrastructure. So really, these are just instruments, and it depends on how we use them. In that sense, it seems only logical that we start thinking of ways of reflecting our thinking around sustainability in how we use derivatives, be it that we include them in the selection of counterparties or include bilateral features. I think we have not yet been involved in green derivatives, and I, as a treasurer, would be cautious of kind of including features which might, in the end, impact the liquidity and the hedgeability of my derivatives, because essentially those instruments are like the oil around the main instruments we use, around the bonds and the loans, which are really what provides the financing. But to dismiss them as something, oh, they don't finance anything. Well, guess what? If I cannot hedge the interest rate risk and the currency risk of my bonds, of my loans, I am putting a massive risk on my balance sheet and endangering the viability of the company, possibly. So they are not financing anything directly, but they are essential to the financing and to the working of the finance of finance infrastructure of a company. So I would, and in my mind, this is paramount. You can improve the instrument you have, but you need to make sure that you don't make them worse instrument for what they are supposed to be. A spade is a spade, and it's there to dig, right? So in that sense, I think there are ways to incorporate this. In my view, it's really related to looking at the ESG quality of your counterparties as in a first step, and depending on the type of derivative, other considerations like specific contractual features could come into play.
Well, look, thank you very much, all of you, for such insightful comments. I certainly feel like I've left this conversation, excited about the progress of sustainable finance into even more corners of capital markets. And I've certainly left knowing more than I started with. So thank you. I would also say to our listeners that the platform will remain open, and that we'll be back tomorrow at 9 a.m. UK time for an interview with the Banque de France. But thank you again for a very enlightening conversation, and hopefully catch up with you all soon.